Hello, everyone. All right, give me a minute.
Hello, everybody.
All right, great. Jeremy, I can hear you, so it's not a problem. Okay, all right. Now, give me a minute, everyone. Okay. Yeah, I think it's much better a little bit. Okay, hi, everyone. Hi, Vincent. Hi, Kafu. Hi, Gary. Hi, Jane. Okay, hi, Diva. Okay, so if you are joining us on this afternoon session over here today, just drop a comment, let us know, and then say hi. Yeah. Okay. All right. Hi, Irene. Okay, so there are many of you who will be joining us from different places because we're streaming this over a couple of places. So just do drop a note, say hi, and then also right to help us in whatever channels you are on right now. Okay, to just click on the share button. Right, click on the share button of the video so we can get this message out. Because today it's really something interesting. Right now, why do I say something interesting? Because I was telling Jeremy earlier this over here. All right, Jeremy started doing up some PowerPoints for last week's sharing. Right, all of you saw that. So he prepared one for today's session as well. And then I sort of went and told him that I really like the story behind today's talk. All right, it doesn't mean that all of you have to like it as well. I'll be sharing it with all of you. All right, but because I liked it so much, all right, I actually bothered. All right, I spent a couple of hours earlier over here to do our PowerPoints on my side of the story as well. All right, now, so today's talk is going to be a bit more in depth in terms of storyline from me as well. Okay, so if some of you are joining us and it makes sense to you, okay, because it should be an industry that I honestly believe that some of you are joining us as I see the hellos coming in. All right, will be able to contribute in terms of some ideas and feedback. Yeah. Okay. All right. Now, so in terms of the stock that I'm sharing today, if you're familiar with the system and the business itself, maybe you could put in the comments over here in terms of the feedback. Okay, what do you think of the reasons that we have behind the choices of these companies? Yeah. Okay. All right. I think that would be a good mix if we start to have some interactions from the participants as well, because the purpose of such a session is not really to kind of like, you know, you come, you listen to us, and then you just, follow whatever we say, right? Because do understand, when it comes to analysis over here, everybody has their own judgment, including Jeremy, including myself, right? So yes, we do present one stock every week, but actually on the back end, myself and Jeremy, we actually throw at least 10 stocks at each other this week, all right, before we actually decide on the one that we have a common goal or common understanding on. All right, so that's what we do as well. So honestly, we do hope as well that if we are somewhat blindsided in our research or analysis, which we definitely can because we're all humans, right? Now, so if you believe you're blindsided to a certain extent about something, all right, do raise them up. All right, raise them up. Not because you want to make us look really bad on camera. All right, okay, but more so because you allow us to go and dig deep in terms of the possibilities that you're raising up. All right, and that allows us a chance to actually make our judgment a bit stronger as well. Yeah, okay, all right, because if it is a flaw, then it allows us to come out and say that, oh, we really missed this out and maybe you should rethink. All right, but if we manage to find something to address the concerns, then it also allows us to know that we have a much stronger analysis than we actually did. Yeah. Okay. All right. Now, so any strategy, any stock picks over here, it's open to analysis, open to I don't want to use such a harsh word, but open to judgment to a certain extent. Yeah. Okay. All right. Because if you like it, it is your money after all, so you have to make the final judgment call. Yeah. All right. Okay. So if you are interested, but you're still concerned about certain things, all right, do address it. Do let us know. Yeah. Okay. Now, I've also understood that somehow, okay, on live sessions, I am meant to speak a little bit slower. I'm not sure if that's an actual concern, Okay, but if it is, all right, can you leave in the comments and tell me if I'm really speaking too fast at times? Okay. All right, now, so if the speed is okay, all right, just type okay. If I am really speaking too fast, all right, then, just let me know by typing slow down over here or something like that. Okay. All right, great. Once again, welcome to everyone who has started to stream in and join us from all our different streaming channels. Okay, I'll try. Okay, I'll try. The first comment to ask me to come and speak a little bit slower has come in. All right, now, welcome everyone to joining us for this weekly episode. Okay, so today is episode 3. Okay, so if you have not done so already, okay, please head over to my Facebook post. Okay, where we are still trying to decide and finalize on the name of the columns. Okay, that means for this weekly series that we're doing, all right, we're down to finalizing it right now. Okay, so I'm just going to put one final week to it. So by next week, we will be announcing the winner. All right, okay, so the winner is going to stand to win a live trading experience together with me and Jeremy. Okay, that's valued at 279 US dollars. Okay, now, so go ahead to the post if you want to leave some a suggestion up, leave it in the comments. Okay, if you want to vote for somebody else's comments, all right, just click on the like button. All right, the like button would do. Okay, so one way to gather more support and votes for yourself is to share out the post and let people know or your friends know to vote for your comments over here. Yeah, okay. All right, now, so please do that for us, okay, because we're trying to make this a weekly segment, not just for, of course, our graduates community, okay, but also for, general investors in public to know more about why US stocks are actually great investments over here, okay, and why, personally, all right, why I would put my cash investments into the US markets rather than any local stocks over here, all right? I can't speak for Jeremy, all right, okay, but maybe Jeremy, you could share, all right? Now, in terms of your cash investments, are they only in US stocks or do you still split them between Singapore stocks and US stocks?
Cash investments are all in US stocks. They give me the best liquidity in a way. Yeah.
Okay. So that means I understand you're still invested in Singapore stocks as well, but that will be your CPF?
Yeah, I do a bit of investment using the CPF funds as well.
Yeah, that's definitely something, of course, all of you should do, because if you contribute to CPF, one thing you understand is there is an investment portion where, if you don't utilize that money, all right, it's going to just sit there until you are capable of drawing it out, right? And
Yes.
you all know we are expected to live longer and longer, so that money isn't going to come back to you anytime soon. Right now, so maybe Jeremy, maybe one of these days we should have a session talking about some potential Singapore stocks.
Sure. I mean, if we can gather enough likes from the community to actually egg me to do that, I don't mind.
You heard Jeremy, right? You have to egg him to do that, because I've clearly and publicly stated many times that I do not touch Singapore stocks. All right. One because it's a certain way. How do I say this? Most of my cash are in US markets, right? And the way I run things over here, I don't necessarily need to make much contributions to CPF. Oops. Right, so I won't be putting those monies in the local stock markets, because there is a need to as well. But many of you who are in a working environment, of course, you're going to accumulate a lot of these savings that are required by our governments or for us, right? To you should consider putting it to good use over here. Yeah, all right. Vincent, all right, Vincent makes a statement over here. All right, I'm sure Jeremy is going to disagree with you to a certain extent. All right, Vincent says Singapore stock market is making less profits than US stock markets. All right. To be honest, in the recent times, that means in pandemic situations, I will have to disagree. I have to disagree because there are many growth stocks that benefits from this pandemic as well. So we can't really say Singapore stocks hasn't done well as well. Jeremy, had you had any Singapore stocks that in recent times have made you quite decent and good returns?
Yes, one of the stock in the portfolio actually returned 30%. I think in a trade that took about 1.5 months. Yeah.
Great. That means after the pandemic crash.
Yeah, during the pandemic crash.
Okay. Are you okay sharing it? Because anyways, ran away 30%, right? Don't chase it. Yeah. All right. Don't chase it, guys.
I was entered into this company called Dutech when it was in about 20 cents. Yeah, and I exited about part of my portfolio when it is about 28 cents. The last I checked, I think it was about 29, 30 cents there about. Yeah.
Okay. Can you just briefly share what was the main reason behind the selection behind this particular stock? Was it fundamental? Was it a story, or what was the thing?
It is an extreme criteria for fundamental screening. So basically, I look out for value play when I am investing my own CPF funds. Yeah, so I use the SGX stock screener to do that. So if you guys like enough for me to aid me to do that, I'll actually be very happy to share how to do that. It's a very simple process. So basically, I park in the funds there, and then when the stock moves to a certain point that I feel I can reel in the fish, the bait, I take back my cost price, and then I just leave the rest for it to continue accumulating profits.
Okay. I see what you're doing over here. So you have a very prudent approach where you still feel that to a certain extent there's some risk. So you put an amount or a trade size where you're comfortable with, and the moment you start seeing some profits on it, you actually start to profit take on certain sizes of it, so that you reduce your risk that is still at play.
Yes.
For those particular sizes, you can just let it run and see the maximum potential, right?
Yeah.
All right, great. Great to have you share. Now, one of the reasons why Jeremy wasn't prepared for that, but one of the reasons why I asked him was because you realize he actually mentioned that the stock price was like 25 cents. Right?
20 cents.
Yeah, 20 cents. Right. So 20 cents, in the local stock market, we'll consider most of these stocks as what we call penny stocks. All right. And usually penny stocks, it's always very hard to associate penny stocks with value. Unfortunately for our smaller markets, because for these kind of stocks to start to appreciate, usually they take a really long time. And out of 100 of them, there's usually only that one or two or a handful of them that breaks out from the whole business cycle, and goes from what we call penny stocks to medium-sized companies, and then eventually to your large caps. All right, so it's a very time-consuming process, but of course it could also be a very potentially lucrative kind of investment strategies. So Jeremy is doing that. So I think one thing we could do is maybe after the session today, I'll just put up a poll. I'll just put out a poll on my Facebook page. Okay, all right, and then you guys can just go to the poll over here and vote if you'd like Jeremy to run a session on Singapore stocks. Now, if you're joining us from Malaysia, I apologize. I don't think Jeremy is familiar with Malaysian stocks.
No, I'm not.
But hey, if any of you are within our community, all right, that means any of you are within our community and you would like to do a sharing on Malaysian stocks, all right, do get in touch with me. Send me a message, all right. I think it's more than valuable to do a session like that to add value to the rest as well. So maybe we could add you in as one of our guests for the week as well. Right, and then if you're prepared for me and Jeremy to throw some questions at you. All right, but all for the benefit, okay? All for the benefit of people who would actually join us and listen, all right, on the weekend. Okay? All right, now, so Kenny says that some Singapore stocks spiked 100%. Yes, definitely. All right, I think during this period, a couple of growth stocks has really exploded. All right, a couple of growth stocks has really exploded. Why? Because we all know that we have read main headline news to say that during this period, many people actually started to take out their cash and actually took on some loans as well. All right, to put those money to work in the stock markets. All right, and eventually some of those monies are going to lead to these growth stocks that are what we call momentum plays or the darlings of the market currently. All right, it's the same thing is happening in US with Zoom videos, with Grubhub, all right, with Teledoc, all right, and with Moderna and stuff like that. There are so many of them, all right. Even the, what people call these days as the new gig economy, right? New gig economy is simply meaning your companies like Square, all right, companies like Square, all right, companies like Slack, yeah, all right, these tech unicorns right now, okay, they are the darlings as well, because people believe that right now the new age of wealth, is no longer the way Buffett has built it. All right, okay, no longer the way Buffett has built it, but everybody's looking to be the next Elon Musk. Everybody's looking to be the next Bezos over here. All right, but what they also fail to realize is Elon Musk and Jeff Bezos itself actually took more than 10 years to get to where they are today as well. So nothing is going to happen overnight. I'm not saying that these tech unicorns are not primed for success. They probably are. All right, but these success are not going to come overnight, as you have seen in their stock prices right now. Right? So many of them are being priced as though they're success overnight. So you have to actually be very wary, okay, of profits if you are already sitting nicely on them. Okay, if you're sitting nicely on these profits over here, you need to start thinking about how you can protect these profits. Okay, all right, now and then just something like that. Yeah, okay. Just a couple of questions, Jeremy, before we get the session started. All right, since we asked this upon ourselves, right? Jeremy, not sure if it's the right forum to ask you, all right, but how do you use the CPF money funds for local stocks? All right, how do you link it? All right.
Yeah.
All right, but I'll let Jeremy answer.
You're gonna need the CPF IS account first. And then once you got a CPF IS account, you're going to need to let your broker know that you have this. And then you need to provide them the videos for them to link it up with you. I think it also depends on the broker that you have for them to really link up with you. Yeah. So generally, to keep it simple, what I will do is I will suggest you approach your broker first. And then you let them know that you have this CPF IS account and you like to actually link it up. Yeah. Also, most brokers, what they do, that they actually will help you to actually open up a CPF IS account if you need to do so. Because ultimately, if you trade through them, there's revenue for them as well. Yeah.
Yeah, I did remember, if first, I guess it's still very much like what we do. You choose a brokerage you're comfortable with, all right, and then they would have a particular few type of accounts that you can open. All right, so for brokers in Singapore, they either ask you how you're going to fund how are you going to make your payments. Yeah, okay, or one of the ways is of course cash, direct debits and internet transfers or whatever, and then the other way is CPFs. Okay, now so that's where you have to set up two separate forms over here, and then you can start to I believe you can toggle, right, where you want the purchases to be made.
Yep.
Yeah, okay, so it's a little bit like, for example, if you trade on Tastyworks or you trade on TD Ameritrade, you can open up to two individual accounts. All right, so if you actually have two accounts with them, then before you execute the order, you actually have to choose which account you're trading from. So something like that. Yeah. Okay. Yes, Uncle Fu. Yes, correct. All right. Yes, Uncle Fu brought up a valid point over here. All right. Now, of course, only certain stocks are tradable when it comes to CPF funds. All right. So not every single stock is. So you would have to check as well if first before you want to go ahead with that stock if it's approved for CPF funds to be used as well. Okay, all right. Jeremy, is there a list of these stocks that people could look at immediately?
There is. What you can do, or rather, what most people do is that they try and start from the list itself. But I would say that what the process I do, which is different. I start from screening the stock first, and then I load to the stock list, and then I'll see whether they are approved. If they are not, I just skip them and just continue moving faster. It's faster that way.
Yeah. So first you look for the stocks you're interested in, then you see if they are CPF approved. So if they're not, you move away. If they are, then continue your research.
Yes.
Well, it makes sense as well, because ultimately, if you want to invest in a stock, especially locally, you would have to buy the stock itself. So it makes more sense to do the stock research and analysis first before you go on to others.
Yes.
Yeah. All right. Great. Thank you very much. So let's get our session started. Everyone ready? All right, if you're joining us right now and you're ready, all right, can you just leave in the comments over here, ready, all right, and then we'll get go. All right, ready for the session, all right. If you have not done so as well, all right, please click on the share button. Let's share it out. Let's get more people joining us on this weekend afternoons over here. All right. So, most of us, yes, we are heading out, but, it's still pretty much safer right now to stay at home. Yeah. All right. I don't care whether it's the norm or the new norm right now, but, keep yourself safe, everyone. All right. Okay. Keep yourself safe. How to post, Elvin, I'm not too sure about this. How to post the question on the upper screen. I think, Elvin, you could just leave your comments, right? Just leave your comments on the Facebook video where you're watching it itself, and we should be able to see it from our back end over here, okay? All right, great. Everyone's ready. Okay, let's go. Okay.
All right.
Jeremy, so today I said to you earlier, you get the lead, all right? So
Yep.
you go first, Jeremy.
Okay.
Hey, please go ahead with the numbers, and I'll come back with the stories after that.
Sure. Right, can see this, right? All right. Okay, everybody. We still need a name, so this is a shout out again. Please go to Terrence's Facebook page. Do share your ideas for this stock tryout sessions. If you just joined us, this is the session you're looking at. This is the third session of this kind. Do leave the name that you have suggested, and if your name gets picked with the most likes, you get the chance to actually win a trading session with me as well as with Terrence. That's worth about, I think, close to $300. All right. So we're gonna move into this company called CVS today. CVS Health Corp. Okay, so the profile for it is an integrated healthcare services company. What it does is that it combines both the pharmacy benefit as well as the pharmacy operations. Okay, so you just think about it, it's going to be providing the medicine to the patients, as well as right now, as I understand it, also does a managed care. Managed care is something relatively new. What it does is that it helps the patient looks out for alternative, what they call it, second opinion as well as third opinion in terms of the medical providers out there in the market, and then they do help the company, the CVS itself, to manage the overall cost in terms of treatment, because sometimes the treatment that is being prescribed, right, that it might not be the most effective treatment across board. So generally, it's a trend growing in the insurance industry, whereby by offering customers different medical opinion, right, these insurance companies helps to manage their overall claims experience, overall claims amount, right, in the long run. And in doing so, they have a better numbers on their balance sheet as well as on their statements itself. So CVS as a profile, right, is kind of like poised to have a better control in terms of the overall healthcare cost, right, for its clients. Okay, so where we're looking at is CVS, right, these numbers are, the stats are all taken from Morningstar. CVS, right, if you look at the trading return, right, for the company, it's actually trading return, right, it's actually catching up to the industry. If we look at the 5 years return against the healthcare for the industry itself, CVS was performing not so good as compared to the industry. And in the last 3 years, it was also not as good. But if you look at the last 1 year, it was actually catching up. In fact, it was slightly overperforming the industry itself. So we see something like the company that is playing catch up and in fact already overtake already. So we examine that closer in the numbers later, all right? And if you look at the financials as a profile overall, CVS is trading slightly above book value with a price book value of 1.23. Okay, 1.23. Meaning to say, right, for the price that was taken when the this financial summary was done, for every dollar you put in, right, you are actually overpaying by about 23% on the book value of the company. Okay, and why we look at the book value is because generally, if let's say for example you're gonna buy something, like I mentioned it before, if you're gonna buy something, you wanna buy it when it's dirt cheap, and you're gonna buy it when it's very expensive. Similarly, when you're selling it, it's the other way around. So right now, we're gonna do a company whereby you consider you park your money in, right? You want to do it when it's cheaper. So if let's say for example, we're looking at price book value that's a 1.xx, is generally respectable. 1.2 something, we're looking at something that might be of a value to you. Okay, the same place, right, we're looking at price to cash flow of 5.64 as well as price to sale of 0.31. Meaning to say right now for the price of the stock you're paying, for the free cash flow that you're generating, right, is about only 5 to 6 times that you're paying. For example, the stock price now, you divide it by 6. That is the amount of cash flow it's generating. For the same amount, the sale is about 0.31. So generally for me, when I look for a company, if let's say I see a cash flow, price to cash flow of under 10, that is something that I can pay attention to, especially for sale as well. Whereas if you see something of these numbers, you can actually go deeper and dive in to see their numbers, see their financial statement. Okay, and we're saying this company has a positive growth since the last 3 years. We're looking at a 3-year block. Okay, so positive growth for the last 3 years. So we don't have to worry about whether this is a company that is not growing right now. Yeah, and let's see. Now this is one of the first part whereby I don't really like what I'm saying. The financial health, like those short-term quick ratios, if you don't understand what the quick ratio as well as the current ratio, you can go back to our Telegram group. Look out for the quick ratio as well as the current ratio definition. The quick ratio and the current ratio, the difference is the quick ratio is more conservative. That's why you see quick ratio as 0.60, whereas the current ratio is 0.90. What it means is, right, okay, let's just round up. Okay, current ratio is about 1, meaning to say CVS's company has enough cash flow to, or rather enough short-term assets, right, to cover for their short-term liability. But if we take a more conservative approach, right, using the quick ratio, we're looking at about 0.6, which is slightly about 6 to 7 months' time. This is not as healthy as it is, but taking into account the nature of its business as well as the overall health of the business later, which we examine, right, it's not too much of a concern here. Okay, yeah. So also this company has very excellent, very good interest coverage, meaning for the amount of debt they need to pay for interest, yeah, we have about 4 years worth of interest that they can pay, which is very respectful. Generally, if I understand, we're looking at about anything under 1.5 is a distressed amount. So anything above 1.5, in fact, more than 2 is good. So 4 is overkill. So it's very good here. All right. And not nice, what we see here is that the debt equity, we look at about 1.42. So the amount of debt, right, to the amount of owner's equity, if you understand financial statements, right, is pretty high for my comfort. But we're just gonna see and dive deeper to see whether this company is worth looking further into. All right. And best part is the company is now already profitable. It's already making profit now. Okay. So why is CVS so cheap in terms of price book value? We just need to pay attention to that. Right. So you see in the income statement, right, we see that CVS as its operating income. Now, if you have been to the last session, the stock trial session number 2 last week, whereby we went through KMI, you will notice, you recall that I did mention that we want to pay attention to operating income, right? So the business has to be able to generate most of its income from its core business, not from its investments, not from its financing activity. It must be from its core business, right? So for operating income, we're seeing an increasing trend from 2017 to 2019. In fact, during 12 months, right, even with the COVID-19, right, we're seeing that numbers are still growing. So this is very strong numbers here. And at the same time, right, we see net income, it is positive now. And in fact, with the trailing 12 months figures, right, with now July, we're seeing that it's already surpassed that of 2019, meaning to say the first 6 months, let's take 6 months. The first 6 months of this year is actually performing better than the first 6 months for 2019. Okay, so earlier I mentioned, why is CVS so cheap in terms of its price book value? If you ask me, I'm going to attribute it to the fact that in 2018, there was a net income loss. That means there was a net loss in 2018. All right, so, but is that going to be a concern here if it's a one-off? I don't think so. For me personally, I don't think so. It's just going to be a one-off thing, and it's already turned profitable. At the same time, I'm going to see that the EPS, earning per share, right, is still positive. Okay, yeah. And let's move on. You see, for balance sheet wise, right, we see that we want to have a growing trend for assets. Now, for assets, right, the normal check that I look out for is, again, we want to make sure that there is no disposal of assets, right, to account, rather to have a creative attempt at accounting, you get what I mean? When a company tries to sell assets, right, to puff up their figures and make it look more nicer. I'm not really seeing this whereby you see the assets are still growing every year, year on year. The not too good part is that we see liabilities as well as debt is actually increasing at the same time. However, the better part is total equity is still increasing. So the Hobie formula for accounting, whereby assets minus liability equals the owner's equity. This one I think a lot of accounting students will hear and just sit already. Right. So we see that, okay, assets minus liability equals owner's equity. So this part is still increasing here. So this is generally a good sign here. Okay, so we just want to make sure that the liabilities portion don't go out hand here, right? But if you recall, the interest coverage, this part is still getting a good coverage. So it's not so much of concern here as long as in the long run, the company doesn't let the liabilities as well as the debt go out hand here, all right? And we're seeing this is the cash flow statement, all right? So for operating cash flow, we're seeing a very solid operating cash flow. This is consistent with the operating income, and the free cash flow is also very healthy. So, well, if we look at the valuation for this company against its 5-year average, right, we're seeing that they are, how do I put it? It's like very close, it's like cheaper in a way, but how would I put it? It's cheaper. It's cheaper than the 5-year average if you just compare, but they are not better than the index. Okay, so you have to understand, this company is performing better than the average summation last 5 years on against itself, but it's not performing better than the index. So if, let's say, for example, you're looking out for something that is going to perform now, go for the index, go for other companies in the market. But if you're looking out for a growth play, you can consider this company. This is my straightforward logic you look at it. Okay, so look at the numbers, right? Okay, price over earnings, price over cash flow, price over book, which is what some of the numbers we have examined earlier. All right, so we generally do want to overplay, and I believe there's a certain way of interpreting these numbers whereby these are the enthusiasm level of enthusiasm whereby market participants are willing to pay for this company. But for me, when you see, if you are going to overpay, say for example by price book, if you're going to overpay by price book, right, then there will be a certain level of correction whereby if the price of the stock is too high, the price of the stock will be corrected such that the price book will be more in line with the norms, more in line with the averages. So I tend to look for companies that are closer or at least slightly better than the 5-year average. Okay, so in terms of the return on assets, right? Okay, now this is the part whereby it's not too much of a difference if you look at the return on assets versus return on equity, but the net margin is seeing a slight improvement. Whereby we're looking at 2.76% now versus 2.49% back then. Okay, so this is the 5-year average for net margin. So this is a company that is currently increasing its net margin percentage against its 5 years average figures. So where does this leave us? We can examine it later. Okay, so in terms of dividends numbers, right, okay, this is really something that I don't have an opinion on because CDS as a company, right, hasn't changed its dividends for a longest time. It's just holding on to it. But the notable part, right, is, you see, it hasn't changed, right? But the notable part is payout ratio is within a healthy figure. So we're going to see that we will be able to sustain its dividend payout. So the risk of having it cut its dividend and resulting to causing a cut in the fall in the stock price, right, is going to be lower. So we want, if let's say for example, they can just continue paying the same amount of dividends, we are fine. If they go up, it's a bonus to us. So overall, we're looking at a book value for this company from Team Top Stream platform. Book value per share, right, this is about $49.05. $49.05. Okay, and let's see. This is taken this morning from Think or Swing platform under the options change CDS. For the options of expiring 21st of August, right? Same practice. I'm gonna look at a covered call strategy. For the strike price between 42.50 to 52.50. Yeah. So these are the premiums. So if I extrapolate them, right, we're looking at annualized returns, right, between 0.82% to 6.93%. All right. Why do I actually include in the 52.5 when the book value is only 49.5? Because there is a implied volatility cone expiring, whereby it shows that if, let's say, for example, for expiry on the standard expiry for August, right, there is a 68% chance that the price will be within $54.84 to $69.99. Meaning to say, right, this is gonna be one of the logically we can consider. So if let's say, for example, you guys gonna do a simple cash covered put to do this trade, I think as a way of building a portfolio, this is gonna be a worthy try. All right, and if you want to do something that is beneath his book value, you can consider these three strike prices, which is between 42.50 to 47.50. Of course, if you do it lower, then the annualized returns as well as the individual returns will be lower. All right. Now, the thing is, right, for this company, the caveats are looking at a company that was previously damaged, because if you recall, in 2018, right, it had a negative return in terms of its net income, but it's already recovering, and I would say it's recovered, right? Now, the thing is that this company is a potential value spot in the industry, meaning to say, if it continues its recovery trajectory, right, we're gonna see a very good, how I put it, you're gonna pay off very well. But if they do not, right, this is gonna be a value trap. So that's why I do not advocate going long directly on the stock. I would rather do it on the option, right? And but if let's say, for example, you're gonna like buy the stock, or you're gonna do the option play, you have to be willing to own the stock for a long time, because even though if you do the cash covered put, right, the annualized return is not gonna be high, but at least I think in terms of annualized return for the premiums that we collected as a synthetic dividend is still respectable. Yeah. So I think generally this is a company that I will be willing to actually park my funds in if I were to look at building a portfolio for the long term, and throwing low ball offers, right, to long the stock eventually if the stock does have a dip in price for a short term period. Yeah. Terrence?
Sorry, hang on. So Jeremy, so that's your analysis on the company, right?
Yeah.
Okay, so you're pretty much picking out a simple portfolio naked put on CBS.
Cash cover put.
Okay, yep. So basically in project options cash flow, we call it the portfolio puts.
Yeah.
Right, so yes, we can have a look at that. And I think Jeremy's analysis was simple to understand. He went out to dig out the potential, was it book value, Jeremy?
Yeah.
Yeah. Book value of the company, which sits at around $50 a share.
Yeah.
Yep. All right. Book value of the company, which sits at $50 a share. So simple way of looking at it is, this is technically, if the company does fall into trouble, all right, it has to liquidate itself, it has about $50 per share worth of assets that can be sold off and collected back. Now, so if you, in theory, buy the shares at those price, so that's where you are actually getting all the potential in the business for all the assets that they have, from a very fundamental standpoint.
Yes.
So let me share with you my story. Okay, I basically agree mostly with what Jeremy has said. Let me first declare, put a disclaimer to all of you that when me and Jeremy actually select a stock for discussion over here, the one thing that we agree on is basically our outlook on the stock, but we do not actually share with each other what our presentation is going to look like. Yeah. Okay. All right. Now, so Jeremy's part is really in terms of analyzing the numbers. Okay. And most of you who are in our community right now, you know that I am someone, all right, who probably don't like looking at numbers, all right, or I look at a very basic number. So once I get the numbers I want and I see, okay, I move on to how should I structure the option trades itself to, basically maximize the benefits. Okay, right now. So for starters over here, let me answer some of the questions that is being put up right now. Sorry. Right now, CVS pays dividends, right? As Jeremy shared on his screen right now, CVS dividends right now are $2 per share per annum, right? $2 per share per annum. So that sits at around 50 cents a quarter, right? So CVS is paying about 50 cents a quarter over here. Okay, now, so let me get my PowerPoints up and let me share with you my story. Okay, all right. Now, please don't expect every single week on every stock I'm going to have a story as detailed as today's one. All right, okay, but the reason why I believe that this stock requires a PowerPoint from me, right, is because interestingly, Jeremy just brought out the point earlier. All right, what do I mean by Jeremy just brought out the point earlier? It's a damaged company. Yeah, okay, it's a damaged company. Right now, so if you are within our community, all right, and been with us for since 2016, actually, right, 2016, 2017, actually, right, you realize that CVS was a stock that we really liked a lot, right, because as you see until today, it's still a value play. Okay, but what has happened is the whole company itself looked damaged from 2017 and 2018. Okay, all right, but I only kind of figured out recently, that it is not so much a damaged company, but a misunderstood company over here. All right, now what do I mean by a misunderstood company? You see a lot of CEOs, okay, a lot of CEOs of big companies over here. They usually run the company, or when they take over, they usually run the company for what we call the near-term profits. Okay, now why near-term profits? Because near-term profits immediately gets reflected in the stock price. Okay, all right. But if you're really looking for an investment, that means an investment criteria kind of stock, then you actually want a CEO or a management board over here that looks at the long run of the business, the long-term viability of the business. Right. For example, what do I mean? Right. Everybody claims that Steve Jobs is a wonder. Right. Now, why do we say Steve Jobs is a wonder? Because he took years and years and years to come up with the right product and the right ecosystem. Right. It did not just happen overnight. Yeah, okay, but the moment he came up with the I system over here, everything in I and produced with an I word in front of it started clicking, started making sense. Yeah, okay, all right, and that's what brought Apple to where it is today. Okay, but it did take a long time as well. All right, from the days where Apple started producing Macintosh to the first iPhone. That was a period where it was really tough. The numbers looked terrible. Yeah, okay, but eventually the company turns out. So the first thing I want to say is, before I start my segment, which kind of a CEO do you want? Do you want a CEO that builds short-term wealth, all right, or short-term profitability for the company, or a board of management that actually has a long-term view in terms of where they want to bring the company to? Okay, now I want to lay this out because this leads to my presentation over here. Okay, now so just as a disclaimer over here, right, before I start my session, as well as for Jeremy, anything we share over here are mainly our personal views on the company itself. So even on the trades that we are looking at, it is the way we would trade based on our money, all right, and what we think is great. So if you're going to follow any of these, please make sure you do your own risk analysis, all right, before you do so, okay, or seek your professional advice before you do so, all right. Now, so what I wanted to share about today first, okay, is not so much CVS. CVS comes after. Okay, what I want to share with you today first is about the environment today. Okay, now what do I mean by the environment today? So Jeremy shared with you earlier, CVS is what we call a healthcare company. Okay, so it's not a biotech company, all right? So it doesn't invent the drugs, okay, all right? Now, what it does over here is it is a place where you go to get your medicine, okay? It is your local store, it is your local pharmacy, yeah, okay, all right? So I've told many of my students before, think of CVS as, your Watsons and Guardians outlets with a pharmacy inside it. Yeah, okay, so yes, most of the time you'll go there to buy your medications if you're not going to the doctors. All right. Second, all right, you will go into those stores to get your convenient stuff because they are, usually their outlets are very inconvenient locations. Yeah, okay, so that's how basically the companies look to make their money over here. But in recent times, okay, what we've seen is because of the COVID crisis, right? We have all heard of this recently as well. The CEO of Microsoft said we have seen digital adoption, all right, move ahead in 2 months what it should have taken in 2 years. Yeah, okay, so because of this digital absorption over here, okay, one thing you realize is because of COVID, okay, most people do not even want to go to the doctor's office, all right, because obviously you know why. All right, okay, during this period, especially if you think about it, in America right now, who goes to the doctors right now? Yeah, all right, one, of course, if you really need to see a doctor. Two, of course, if you need to get yourself tested. All right, now, and in America right now, I'm sure nobody wants to be around people who are potentially a threat in terms of the virus itself. So one darling that really took off in the last couple of months, all right, is really this company you're seeing on my screen right now called Teladoc. All right, now Teladoc, what's Teladoc actually? Teladoc is just telemedicine. All right, so think of it this way: instead of going to a clinic to see an office, this company launches an app, all right, and allows you to schedule an appointment, all right, to see their panel of doctors. All right, so instead of actually going to a clinic, you are able to set up an appointment and see the doctor at your scheduled appointment time. Yeah, okay, so everything is done digitally. Okay, but then you realize that the doctors in the US, okay, please give me a little bit of time. Let me establish this as well. Because if you're joining us from Singapore or Malaysia, or maybe even Thailand, all right, one thing you realize is this: when we go to our local clinics, when we see our local doctors, once we're done, the doctors are able to sell us the medicine immediately. Yeah, okay, because most of the time, these are not covered by insurance that we have. Okay, so we just pay for it and then we walk off. Okay, but in US itself, everything is about insurance. Right, so the doctors, even in the clinics itself, they can't sell you the medicine. They are not legally allowed to sell you those medicines. Yeah, okay, because everything has to be claimed on your insurers over here. They buy healthcare insurance. Yeah, okay, so you need to have specialized pharmacies, which are things that are operated like CVS, right? And they're not the only one. There's CVS, there is Amerisource Virgin, all right, as well as Walgreens, right? All these are competitive pharmaceuticals as well. If I'm not wrong, Cardinal Health is one of them as well. Yeah, okay. Now, so they are all very cash flow based, great companies. They are all value plays as well. Okay, but CVS has taken a back seat over the last couple of years. So give me some time and I'll explain further. Now, so why do I say Teladoc is the darling right now? So as you see in their motto in this diagram I've chosen, all right, you request to see a doctor, all right, and then on your scheduled appointment, you visit the doctor, all right, and then the doctor gives you your diagnosis, your prescription. All right, and then with those prescriptions, you find a way to go and get your medicine. Okay, all right, and then of course you're supposed to feel better after that. Yeah, okay. Now, so I say it's the darling because if you look at the stock charts that I'm showing you right now, okay, you'll see that since November last year, all right, the stock was trading around $80. All right, and with the COVID boom itself, all right, there were more and more people starting to use their service. All right, and since March, while the market was collapsing, this stock was actually going up. Yeah. Okay. Now, so this stock actually went up from March at 120, right, to 230, almost 230, where it's sitting right now as of yesterday's closing. All right. So instead of going down, it's bucked the trend over here. All right, as we went up during the pandemic, and after that, as the market continues to recover, right, this stock continues to go up as well. Okay. So this is the momentum play. This is the hot play right now. Okay. So why? Because this is their story. So the latest pandemic boom is about telemedicine and telehealth. That's the hottest thing now. Nobody wants to go and physically see a doctor. So what happens is this video streaming over here and appointment scheduling app that Teladoc has, right, is the hottest thing. Right? So it's a concept, all right? Obviously, this business is a concept that makes a lot of sense right now. Okay, but you must understand, this is a concept that is being adopted right now because of the environment that's created. All right, and this environment is what we call also a one-off. Okay, a one-off where we can't step out, right? Especially in Asia terms, we are shut down, so we can't step out, right? In America as well, you realize certain states were being shut down for a period of time, so they can't step out as well, right? So during this period, they would rather actually go to services like Teladoc to arrange to see a doctor, all right, instead of actually taking a chance to walk out, all right, and go to a physical clinic. Now, So this over here is a great concept, but you must understand this concept over here is going to be plagued with a lot of hurdles. All right. Why do I say plagued with a lot of hurdles? One. All right. Let's say you and me over here. So how many of us will actually prefer to see a doctor physically rather than digitally? That's one. Okay. Second. For example, say in Singapore, let's say in Singapore right now. Okay. When we visit a general practitioner, a doctor, right, for any symptoms that are related, all right, or signs that are related to, I think is the nose and throat, yeah, all right, nose and throat, right. All we need to pay over here is $10 for the visit, right. Everything else is subsidized by the government, all right. So you can get as many medicine as you want over here based on the diagnosis, all right. As long as it's related over here, all we are charged is $10, okay. But this requires the approval of the government. All right, because it's a grant, all right, to a certain extent, all right. Now, but when you see a doctor digitally, all right, then a lot of things come in as well, all right. Are these processes verified? Are information's protected? Are how do we say this? Patients' privacy over here actually secured? All right. Now, so this provides another hurdle over here where governments may actually say, oh, these only applies to physical visits. All right. They may not apply to online medicine. All right. Now, so these are just part of the hurdles over here. And on top of that, technology reliability is required. All right, and ease to operate. Now, so what do we mean by technology reliability? Now, right now, we even have our grandmas and grandpas, and like your dad, your parents, my parents, right, which are left with no choice but to digitally adopt because of the environment. Okay, but can you imagine the moment that this crisis abates, right, and they are able to start making a choice between the old way of doing things and the new way of doing things, right? You're going to lose some of them. Yeah. Okay. So this is another problem that potentially arises, right? Oh man, I forgot to edit one of them. Give me a minute.
So in the meantime, if you have any questions, right, do leave them in the comments and we'll go through them later.
Okay, I'm back. All right, sorry. I just forgot to delete one of the lines as I was doing my preparation for the slides. Now, so that's one problem. So next over here is, of course, because they had a sudden boom, all right, like Teledoc, they had a sudden boom. So their panel of doctors were probably not equipped to see the number of patients and appointments that they have right now. So, there is a surge in demand, but there is not enough supply. So right now, can you imagine if you're Teledoc, what are you going to be doing? You're going to spend a lot of money, all right, to start acquiring more doctors to be willing to come on board on your service. And all this costs money. That means new costs, new expenses are being made for these acquisitions just to continue to run your business, to serve these new customers that you have. Yeah, okay, new customers that you have. And, because of the issues right now, you also need to make sure that the insurance companies are actually approving, right, a company like Teledoc, right, to be used over here. Okay, to be used. Yeah, okay. Now, so that's issue as well. Now, and of course, the last one is spelling error again, right? Regulatory and privacy concerns. Okay, because we have so much online issues right now. Okay, and Teledoc, yes, they can tell you that all customers' privacy is protected, but what kind of measures do they have? Okay, what kind of measures do they have over here? Then you really have to be very careful, all right? Because we have so many times where even our bank accounts are being leaked out over here, and more so when this is about your health, all right? It's a very private thing over here. Yeah, okay. Now, so that's definitely some hurdles that they have. Now, so what does this bring about? Okay, what does this bring about? First, why has Teledoc gone exponential? Right, it's gone crazy. Look at the stock prices; it's definitely nothing short of crazy. One is because of sales. All right, or not even sales actually. All right, just the number of customers. All right, so in the last quarter, what they've seen is a 92% increase, right, in appointments. Now, can you imagine this? If, for example, if you are an agent, you are a salesperson, and in the last quarter, right, you manage to secure 92% more appointments, right, than you did the previous quarter. What does it mean to you? Right, one thing that is definitely going to mean to you is definitely you are expected to bring in more sales. Right, more sales means more revenue. Right, and more revenue means better numbers. Better numbers means I better try to get in the stock before it's too late. All right, now, so we right now live in a society of what we call the FOMO, all right, the fear of missing out. So stock market is definitely the prime example of this FOMO effect. All right, and that's why you see the hottest stocks with the hottest story right now always has this effect going on. Yeah, all right, just look at Tesla. All right, it's just this classic case over here. Yeah, okay, now, so because of this, it's not the only company that does this. Right, there are even companies like Zoom. Zoom has done this very well in this period of time. Right, and also companies like Grubhub. Right, at first, I was asking some of my guys over here, what Grub does. Right, because I have a rough idea, but I wasn't very sure. Right, so Grubhub in America is simply just grab food. Yeah, okay. So of course, their orders have went up in recent times. So even Uber Technologies is thinking about acquiring the company right now. Yeah, okay, but is it going to be sustainable? Who knows? All right, who really knows? Because SoftBank acquired Grab, and then they acquired Uber. All right, and then they merged Uber and Grab. But until today, Grab isn't exactly making a lot of money. Yeah, they're bringing a lot of revenues, but at the same time, they're still spending a lot of money. Right, so as a company as a whole, they're actually not making. Yeah, okay, and of course, last one is none other than Amazon. Right, so Amazon took 10 years to establish their strength, and I would say this more in terms of this fact, not just establish their strength and positioning, but to create and generate profitability. They took 10 years to master that model. All right, remember, they were bleeding and losing money for 10 years before they got to where they are today. Yeah, okay, and during that time, you see many boom and bust in Amazon share price as well. Right, and I honestly believe this is what you're going to see with Teladoc as well. Yeah, okay, why do I say so? Because this trend that you're seeing right now, as I said earlier, was said by Microsoft's CEO. Right, we have seen 2 years worth of digital transformation in 2 months. So the 92% increase in visits is purely down to this fact. All right, and right now Teladoc management is simply going to take advantage of this and put the best version forward. All right, they're going to put you the best case scenario, right, in terms of what the company can achieve and what the company is set to do. Right, but we know there's so many companies around that put up these expectations, but only fall short at the end of the day. Yeah, okay, only fall short at the end of the day. Yeah, okay, there's so many examples already, right, within our time. Okay, now, so there's still some medical conditions, right? Think about this. There's still some medical conditions that these telemedicine cannot solve, right? The next wave, all right, the next wave of, after COVID is what we call the vaccines and immunizations, right? Can you get it digitally? You can't. You can't get your shots digitally. So which means you still have to, go to a clinic over here, yeah, all right, to get those shots physically done. All right, so while we see a big boost in this growth that the company has right now, the stickiness remains unknown. All right, so you spend so much right now to try and acquire a customer. Yes, you do it, but will your customers stay with you for the next 1, 2, 3, 4, 5 years so that you can create repeated profitability out of them? That's a question that is up in the air right now. Okay, so Teladoc is still unprofitable as of last year. So you must understand they burned almost 100 million. Right, of cash out of a 500 million revenue. Yeah, okay, so this shows you they're still spending a lot of money trying to build their infrastructure, whatever they need, all right, to go about running this, all right, and try to gain profitability. So this rapid expansion that they have right now, okay, will also add cost because they're trying to expand their, infrastructure. So they're going to spend all the money because right now they're seeing more money coming in, right? So they're going to put it to spend whatever they need, okay, to gather to the need for the demand. That means trying to meet the demand that they have right now. But if the demand starts to drop, then they're going to be left invested in too much capacity. All right, and we all know too much capacity, what's it going to lead to? Right, it's going to lead to scenarios like your cruise ships right now, they're just docked and not used. Okay, all right, your aeroplanes right now, they are not being flown, so they're just parked somewhere, which doesn't produce revenue. Yeah, okay, so these are the potential problems over here. So why do I spend so much time talking about Teladoc? because that leads us to today's play. All right, so income's value. All right, so income's value in the sense of CVS Caremark. Right now, why do I say CVS Caremark? Because CVS over here, as Jeremy has mentioned, right, they're building what we call the health hub. All right, they're trying to be the one-stop shop, and they've been trying to do this actually since the company started. Right, but it took a long time to integrate the many different parts right now. But I believe, all right, that they have done this. All right, I honestly believe if you look at what the assets that the company have right now in front of your screen, that they have done it. So what they need to do right now is to integrate all of these components and make it work smoothly. That's all, right? Because look at this. If you fall sick today, what's the first thing you do? See a doctor, right? So if you see a doctor, you see that they have the Minute Clinic right now. They have actually acquired this company, all right, way back in 2006, all right? So this clinic right now is already, in their thousands, all right? And the best part is this, all right? This clinic makes additional profits for CVS Caremark without additional cost. Okay, now what do I mean? This is the same model as McDonald's. So McDonald's was just selling burgers. So their revenue was all down the burgers, all right? Now, and then, I think I would say maybe almost 10 years ago right now, one of the biggest thing that they did was to incorporate and build in McCafe. All right, so by having a McCafe, what they just did was to set up or segment an area of their bigger restaurants, right, and set up an additional booth there, right, with this label called McCafe. Yeah, all right, now, so what it's supposed to do is to sell you gourmet coffee over here, right, inside a McDonald's. All right, so people who don't like the normal black coffee that, the other fast food site is selling, can go to the other side over here for, a version of what they call long black. Yeah, all right, okay, now, but of course you pay more for that. But do you realize then it increased the profitability of every stall of McDonald's, right, that actually has a McCafe inside there? Because people pay more for perhaps the same thing that they would buy in a McDonald's store. All right, and it doesn't add on because the space was already there. There was no additional rental, no additional expenses. Okay, now, then, once you're done with seeing the doctor over here, you need the prescription, you need the pharmacy, right? And the pharmacy is there. It's just after you come out of the clinic, the pharmacy is there, all right? It's right there because it's in the same store, right? And on top of that, okay, you might need to have what we call the insurance approval, right? Because, you don't want to spend money buying your own medicine. It's just simply too expensive in America. So you want your insurance to cover that cost as well. So you need what we call insurance approval over here. So in 2007, right? In 2007, this I can't remember which was the company that they bought, right? But they bought another company over here, right? That deals with this insurance claim, right? That deals with this insurance claim over here. Not sure is it eventually the Aetna one, all right? But they basically bought an insurance arm over here, right? Where they're trying to make themselves a one-stop shop. All right, so yes, you come and see my doctors. Immediately after my doctors, you get a prescription, and I'm able to tell you, all right, if you're approved to get up to how many of these medicine. All right, so can you imagine how much ease it brings to their clientele over here, right? And everything is taken care of. All right, so right now they're trying to integrate every single part of this into what they call a concept store, all right? A concept store called the Health Hub. All right, so the Health Hub is where any problems, just go in there, right? You get everything settled before you get out. Yeah, okay. All right, now, so let me move into CVS Health. Okay, now, so why CVS Health? In the short term, the market is actually a voting machine. So obviously you can see the market is voting for stuff like Teladoc and Zoom right now. Okay, but in the long run, all right, it's actually a weighing machine. All right, so Buffett has said that, of course. All right, weighing machine means eventually, all right, investors will get rationale. Rationale in the sense of they'll start looking at numbers, right? And they'll start seeing if the company is actually making money, making profits. Yeah. So telehealth visits went up, right? So you all saw earlier, Teladoc saw 92% increase. Okay, they saw 92% increase in the appointments that is being made. But very few people actually know that these visits were also shot up with CVS Caremark. All right, okay, they actually saw a 500% increase. Yeah, all right. Okay, so CVS actually saw, digital appointments shot up 500% during this period, not 92%, 500%. All right, and at the same time as well, right? All these telehealth appointments were made simply because, all right, that this company had the vision to spend a huge chunk of money to acquire this other company called Aetna Insurance, right? So all this were being brought up by this acquisition because Aetna Insurance had a clientele, think of it as a database, right? An entire database of customers that can be integrated into their brick and mortar business, right? Now, so even this company right now is not standing still. You see their forefrontness because right now in this period, COVID, right? COVID is amongst us. So what you're seeing right now is, they're actually spending money to think about the future. So right now they're actually exploring with an AI company or a robotics and AI company to start exploring the idea of having self-driven cars to deliver these medicine, right, and essentials to their customers. So you don't want to go out, that's fine. You want, convenience, that's fine. Let me explore this because if they can have, robots doing all this work over here, right? Can you imagine nobody needs to really fuss over seeing a doctor and getting their prescriptions? All right, so they're integrating into every component of their business right now and bring convenience to their customers, right? And CVS Health have 10,000 outlets in locations all over the US. So they are definitely in much prime position to benefit from this trend over here. Okay, now next one I want to bring about is same but different. Okay, what do I mean by same but different? Because earlier I was comparing to Teladoc. Okay, so if we compare Teladoc to CVS, it's totally different. Because one is just a pure play on telemedicine. That means seeing a doctor online. Okay, but CVS is about telehealth and healthcare as a whole. All right, so it's digital health as well as healthcare as a whole. Right, because CVS, right, is actually a customer of Teladoc. All right, okay, now what do I mean? Because sometimes when they can't fulfill their appointments, right, because they have Aetna, right? So from Aetna over here, they have actually an agreement with Teladoc to send over some of my appointments to see your panel of doctors because I can't meet all of them. Yeah, okay, so CVS actually uses Teladoc to fulfill some of their appointment schedules as well. All right, so they're that big over here. Now, in the next wave over here that we're expected to see is the vaccines. So, it's invention right now, but can you imagine the moment vaccines are ready, they are approved and they're out, right? The next wave is definitely for countries over here, right, to make it mandatory, right? Making it mandatory for every citizen to go get their vaccines, right? And of course, we all know that this can't be virtually done. So Teladoc can't get it virtually done, right? But CVS can, right? Because CVS has these outlets, right? Like I said earlier, there are 1,000 minute clinic outlets, right? There are locations that are joined together with CVS. Okay, so CVS is really trying to change healthcare over here as a whole. They're trying, not just to be a local pharmacy, all right, and convenience store anymore. They're trying to incorporate a lot more things. And also, just going to the company website, you see that this company is doing the right stuff. Okay, what do I mean by company doing the right stuff? In America right now, of course, because of the recent events, all right, the whole racism right now and inequality is a big issue, right? But CVS is already making their statements, right? They're investing $600 million to address racism and inequality, right? So, this makes them, in the right position right now. Yeah, okay, that means they show to people that, hey, they are a company that cares, they're a company that, are aware of this situation and they're doing something about it. Yeah, okay, so that's one thing they're doing. Next, they are also, having more than 1,400 test sites across the entire country for COVID, right? So they are drive-through testings, right? So they are also set to benefit from being able to do this as well. Okay, now next over here is they have a health to heart motto over here. So they're trying to do more, right, for healthcare as a whole. So you realize CVS Health is partnering federal and local governments to deliver frontline care over here and support and hospitals. Okay, all right, supporting hospitals and serving the communities. So this resonates very deeply when it comes to healthcare as a whole, right? So like I said, many of you who are listening right now, you may be working in the healthcare industry, maybe in the front line or in the back line over here, right? Do share your thoughts in terms of, if a company is able to integrate everything over here, all right, what does it mean as a whole, all right? Now, lastly, they're trying to manage the cost of care. Because if you realize recently about the whole thing or the debacle of COVID, why is it so bad? It's simply because it's too expensive, right? It's too expensive for people to actually get tested and get cured even, right, for COVID in US, right? It's ridiculous because of these insurance that are put out there, So, CVS as a whole is trying to bring that one, in Chinese, we call it 一条龙服务, right? Okay, so a one vertical integration where they manage every single component. So because they're managing every single component, right, they are able to better manage the cost over here, or try to effectively bring down the entire cost of this process over here. Yeah, okay. Right, lastly, let's get to the big game. All right, so what's the big game on CVS as a whole right now? So CVS right now is planning integration, right? And they're planning vertical integration, not horizontal, but vertical. All right, so many business, what they do is they try to expand horizontally by having more different perspectives and trying to get customers to buy more, horizontally. But what CVS is trying to do is to grow in the same line, right? Like we said just now, from seeing the doctor to prescription medicine to selling medicine to insurance claims, right? They're trying to handle every part of it. So from visiting doctors to getting a prescription to buying medicine to insurance claim approvals, right? And they want to be every single part of this. Okay, so they acquired Minute Clinic outlets over here in 2006, and then they went on to acquire database management for seeing doctors in the sense of Caremark RX company in 2007. Right, and then they went on to their biggest acquisition, right, which is Aetna Insurance in 2017. Right, and Aetna was actually their downfall until today. Okay, now why do I say Aetna is their downfall until today? Okay, one, because they spent a lot of money to buy it. Not that it's a bad investment, but they spent a lot of money. Right, two, right, they took on a lot of debt, all right, or new debt to fund this acquisition. Right, and three, all right, because of the nature of this acquisition, right, it wasn't approved. It took a long time, all right, it was only approved, I think, in 2019. So they spent 2 years fighting, right, for the rights for the merger to actually go through and to be approved over here from the federal government. Yeah, okay, all right. So it was 2 years after they, announced the acquisition that they finally got to make it move as a whole, all right, and integrate. Yeah, okay. So that is a loss of time and a loss of a lot of money in that process. Okay, so consumer benefits from all these quicker approvals and less regulation scrutiny. Okay, so all in all, right, we seem to be getting what we call a growth as well as a value play out of CVS over here. Okay, now, so having shared my entire story or my view of CVS right now, okay, I want to show you something that contradicts totally. All right, something that contradicts totally. Because if I'm going to show you CVS, this is CVS. Okay, and I'm showing you CVS from 2016 until today. All right, I put those question marks out there. Why? Because while based on the story that I'm sharing with you so far, right, it should look as though like the stock should be doing and flying and doing really well. But as a whole, you see actually the stock is on what we call a downtrend over here. Yeah, all right. Why? Why? Because like Jeremy brought up earlier, the current issues. Right, the current issues led the stock price to where it is right now. First, it has years of conservative balance sheet because it's a cash cow business. Right, people come in, people buy their medicine, and these people, whenever they need medicine, they need to come to me. So it produces a lot of cash flow, right, of repeated clientele. Okay, now, so for years, they have a balance sheet, all right, which is very conservative. But it turned bad in 2018, just as Jeremy highlighted. Right, what are some of the reasons? Why? Right, one, possibly because of the announcement of the Aetna acquisition. Right, and you see further down the slide, Aetna acquisition cost them $70 billion. Right, it was a $70 billion acquisition. Right, and they now until today have an outstanding debt load of around $90 billion. Right, so it's a $90 billion debt load. That's why it looks terrible. It looks bad. Okay, but all this could be assigned down to just that one acquisition over here, and it can't be worse. It can't be worse because, like I said, it got approved officially sometime in 2019, and before they could milk some real substantial profits out of this approval over here, right? The pandemic struck, right? So the pandemic struck and obviously caused another cash flow or strain on this company's profitability over here, right? So right now in the stock market, after the COVID and the correction over here, investors are shunning all companies that have bad balance sheets, right? Why? Obviously, right? It's a concern because you saw all the retail outlets with a bad balance sheet. They're all lining up right now to declare their bankruptcy, right? So, any company that has a slightest risk of bankruptcy over here, right, are being shunned by investors, right? So they don't really care what kind of plays you have, what kind of story you have, but they're just shunning you in total. They're not even interested in trying to find out your story, Okay, they're just more interested in chasing after the companies that look like they have a better balance sheet. All right, that's all. Yeah. Okay. Now, so this actually presents the value play because this company right now is being shunned, right, because of their bad debt load. Okay, so they have about 90 billion of debts right now. They have about 10 billion of cash that's sitting in their bank, right, and they generate about 19 billion, right, in earnings before interest and tax. Yeah. Okay. Now, so investors just don't like this. Okay, but there's something you need to pay attention to. Okay. Why am I insisting? Why am I going for this over here? One, right, because this business is essential, right? It's on the essential list over here. So while many businesses are closed during this period, all right, okay, this company earns the right to remain open. All right, and more so, as you saw earlier, there are 1,400 test sites for COVID over here. So they are going to remain open, right? And people need to buy their medicine, right? They need to come to these outlets over here to buy those medicine. All right, on top of that, I'm not sure if I had it on my slide earlier. I may have missed it out adding to my slide. Let me confirm this, okay? I missed adding this out. Okay. Now, so while their telehealth visits actually went up by 500% in the last quarter, right? Another thing that went up was, their medicine delivery. All right, their medicine delivery. That means instead of people needing to come to the stores to buy their medicine, all right, they actually deliver it to their house, right? They actually shot up by almost 1,000%, right, in the last quarter as well. So this is absolutely ridiculous numbers, okay, in terms of the cash flow or profitability that a company can generate in just the last quarter. So this actually starts to show up because Jeremy has said that their fundamentals have started to turn, right, and the numbers actually start to look much better right now. Okay, started to look much better right now. Okay, now so management has also made it essential, right now to pay down the debt because they understand what investors want. And they realize because most of them actually are shareholders as well. So because they're shareholders, they will want the share price to go up, right? Because that eventually weighs down on their bonuses, their net worth, and how much their kind of pay packages are. Right now, so they want to manage debt, and they made it a priority in their business. So right now, we're really seeing a case of classic case. I'm taking on debt, but is this debt that I'm taking on, right, good or bad? That means, is it taken on because of good purposes, or is it taken on simply because I just feel like it, right? And everything that I've just mentioned so far in terms of storyline, right, seems to point towards that this is a form of good debt that the company has taken on. Yeah. Okay. So the current free cash flow margins are also hitting what we call all-time highs. Why? Simple. They are a company that benefits from this environment right now as well. Okay, all right. Now, so with a PE ratio of the company sitting at around just 12 right now, compared to the entire S&P 500, which we know is much, much higher at the moment, there are very, very few, right, plays that can give you this kind of advantage or present these kind of values that we're seeing in the markets right now. So lastly, they've recovered from the COVID low that they made, which is $52, right? But they're still, way off their highs over here of 95, way back in 2016, right? So if you look at the charts over here, right? So this is the COVID low, which is 52, right? They did the same low over here back in 2019, right? So if you want to be technical, all right, we could see a double bottom over here, right? So a double bottom where if, CVS can break the $75 mark, right, it could actually go crazy. Right, it could shot up immediately back to their previous high, which is almost $100 over here. All right, now, and with the storyline that we put out, right, and the potential profitability that a company can start to bring in terms of their business from the vertical integration, right? It seems, right, that if you give it time, if you give this company time, right, it seems like it is capable or more than capable to do something like that. Yeah. Okay. Right now, so that brings me to the end of my story. Jeremy, are you still there?
Yeah, I'm here.
So Jeremy, this was the big story that I was telling you about earlier, right? In terms of CVS over here.
When I listened to the story, right, I was just reminded of the story of Coca-Cola and McDonald's. I mean, in the first year, Coca-Cola was selling something like 99 drinks a day. And then I read it was actually the change in the environment in terms of the technology breakthrough that I think it was a breakthrough in refrigeration technology. It actually led to the Coca-Cola achieving a new heights. And yeah, so I think what we have here in terms of COVID-19 was actually this breakthrough in terms of the overall environment for CVS that we need. Yeah. Yeah.
But I mean, to me, the one thing that it really stands out and what I really like in terms of the story that I see, it's the whole idea that the company has adopted in terms of building that vertical integration of their business.
Yes, yes.
Yeah, because you know, in healthcare, right, there are so many components that plays, especially in America. Yeah, right. So if you actually own the entire flow chart, all right, to a simple way of putting it, if you own the entire flow chart of the businesses involved in this cycle, then you know you're definitely going to be a standout. Because every part of the puzzle, right, you know, is required to earn a little bit of their profits. So if you are owning one part of the puzzle, it's only that much profit that you can make. Yeah, right. Whereas if you own the entire flow cycle over here, that means you know, and the entire profitability is yours, and you get to manage it as well, and you get to position it such a way where you can make the entire process much more cost competitive compared to your competitors, which are all individual outlets on their own. So I think this is very much in terms of their competitiveness over here. That's basically what I like a lot about it.
I think you have a point here, but as you see this, I'm just thinking, were these companies eventually run into antitrust issues?
They had. That's why a lot of people were stopping them from the acquisition of Aetna Insurance. That's why they took 2 whole years to get it approved. So once it's approved now, there's nothing that can stop them anymore. So they went through the hard part or the hardest part, which is the approval. Because once they're approved, that means they officially own Aetna Insurance now, right? So they already got every component that is needed. So now it's just the integration part. That means making every wheel run smoothly and as a whole vehicle. And when they do that, can you imagine the cash flow and the profitability that a company eventually brings in?
Yeah.
Yeah, I think so. Yeah. Go ahead.
I think you more or less, I mean, I can see the reasoning here because like what I told everybody in my sharing earlier, if let's say, for example, we're going to do this, right? We're looking at a value play, and if you're scared of a value trap or you're looking for something that is more immediate in terms of paying out now, then this is not a play that you want to need now. But if you're looking for something that pays out to pay you in the long term, then this is something you can consider. But I'm more concerned in terms of whether the participants we have for today, right? Do they have any questions in terms of what we share this story? Do they actually buy this? Do they have any questions that they want to share? Do they have any perspective that they would like to?
Yes, definitely. That was the next thing I was gonna. Yeah, that's the next thing that I want to reach out over here because you know, those of you who are still listening in right now and you're with us. Okay, this is really for you. Right, it's really for you and made for you as well. So we really start to, especially Jeremy and myself, we really start to like to gather your opinions, your thoughts, and your feedbacks in terms of the stocks and the pointers that we have raised over here. Right, it doesn't mean that we are always right. Okay, but of course, you know, if you like the story and you buy the story as well, let us know. Right, let us know because then we kind of are able to start to formulate what kind of stocks, what kind of opportunities that you guys are actually liking in such a session like that. Yeah, okay, all right. Now, so that's basically the different kind of things we can look at over here. Right. So anyone who's joining us over here, all right, what do you view in terms of the virtual integration of what the business is trying to achieve and do? So you realize, Jeremy, virtual integration is a long-term process. So the near term, that's why the company hasn't been looking too good over the last couple of years. Right, they spend so much money in this acquisition, but it obviously shows that the management is very confident that this perhaps is going to be the last piece of the puzzle that they need. Right, and that's why they're willing to put up so much money to make this acquisition happen.
Yes, I think if let's say for example I could put what I know locally in the context, right? So I'm more geared towards insurance company for my background. So I'm just going to share what I know as a for the insurance company in Singapore here. Okay, so many of you, if let's say for example you're watching this from Singapore, you would be aware that our medical costs are actually going up on a year-to-year basis, and this has been the national headlines for the going maybe the last 10 years. And if you're actually a buyer of medical insurance, right, you're going to be wondering why is your medical insurance premiums going up. But as I understand it, right, there's actually companies that actually has done something similar to what CVS has done, which is what they did in terms of having a managed services. By managed services, what I mean is that they have a partner or a division or the department in the company whereby they try and source for more affordable healthcare partners, be it doctors, be it healthcare groups that they can put into their preferred providers to allow their clients, their insurance providers, their insurance clients, right, to actually utilize these services so that overall the premiums for the cost is more manageable. So just on that part, right, so I think what CVS has done is actually something like a global trend. It's not going to be isolated situation here. Yeah. And let me just think. I think generally for such kind of case, right, it's going to be a strategy that will pay off in the long run. Yeah. So if we see that this is going to be like a short-term play, we only looking at the short-term play, then this is not something that we're looking at enough. That means the what is it called? The dream is not big enough, you see. So as much as like, for example, in my slides, I want not to go long the stock because it could be a potential value trap, right? For me, I would want to long the stock, but I don't want to run into value trap. So now I'm stuck in the situation but I don't want value trap, but I want to long the stock because I want to get a long-term return somehow. Yeah. So if I can structure something that I can do that, I can get this very long-term return, then I'll be happy. Yeah. So I'm just sharing out loud. I just don't know whether this is something that can echo with some of the views of our viewers here.
Yep, sure. No problem. Let's just answer some of the questions over here first. Starting to come in, so that's good. That's very good. Chi Hong over here is basically asking, is there any similar competitors, all right, to what CVS is doing? All right, Jeremy, you want to answer this before I go ahead?
I'll say all the different competitors, they're trying something something similar to a different degree. But in terms of getting close to what CVS has done, right, there's none that is so close. Yeah.
Yep. All right. Now, I have a different take. All right. Now, so
Sure.
Much like just what I mentioned earlier, there is no pure play competitor in terms of what CVS is trying to build right now. Okay, that's why it makes this business in such a special position right now. Okay, all right now, and please take this with a pinch of salt, okay? But in my community, and I think even Jeremy would verify this, there are very few instances where I'm so detailed and insistent on a particular company in terms of the story. Yeah, all right, because there are very few companies that will have a story that makes this much sense in the long run as compared to what CVS is building. Basically, what we're looking at right now is the foresight of the management, right? Because a lot of businesses right now are so short-term focused. CEOs are just designing policies to make sure that they keep their job and look good until their term ends, right? Rather than build, a business that really provides sustainable profitability in the long run to come. And I believe CVS came out is trying to do something different over here, right? So in terms of competitors, right, they are no direct competitors, but they are competitors in terms of their pharmacy store outlets. Yeah, okay. In the sense of, like I mentioned earlier, there's Cardinal Health, all right. There's Walgreens Boots Alliance, right, and then there's Amerisource Virgin. Okay, and actually, there is another reason why all these companies, right, need to plan their own path and different ways to increase or expand their business, because filling prescriptions, selling medicine is a very thin margin kind of business. right? I believe that margin rates are anywhere from 5 to 8%. Right? That means their cost of buying the medicine versus what they can sell to their customers because of insurance costs and everything, right? They make only a profitability of 5 to 8%. Right? So it's essentially, right, like what the technology companies are doing right now. If you know, right, if you go to any IT fairs out there, right, you realize you don't get any substantial discounts on laptops that are being sold. Instead of getting substantial discounts, what you're getting instead are freebies. All right, because freebies are actually very cheap. All right, you may buy a mouse for like $20 if you buy the mouse because you need it, but actually the cost of producing the mouse is probably like $1 or $2. So the company is able to look like they're throwing you very expensive freebies, which actually cost them very little money to produce. Yeah, okay, they are more adamant on doing that than rather cutting $100 on the laptop price itself, because $100 cut is $100 cut, but giving you $100 worth of products or $200 worth of product actually cost them $10 on the back end. Right? And that's because laptop business actually operates at under 10% margin. And they need to build assembly plants, salespeople, and everything like that. All right. And all they're doing is trying to sell more so that this 10% margin makes sense. All right. It's like in Singapore, all right, we going to Bread Talk every day. Right? Look at how much not Bread Talk, but Toastbox. All right. Toastbox is forever crowded, but do you know they make less than 10 cents on every cup of coffee that they sell? All right, so it's a volume business. It's not a profitability business. Yeah, okay, so I think what CVS is investing and doing right now is trying to change all that for their company. Yeah, all right, so hence the value over there. Okay, all right, now, so Ryan's question over here. How long do you think CVS is going to clear the debt? Or, can they clear the debt? Jeremy, what do you want to put some insights on that?
I wouldn't say how long, this is something that we cannot predict, but I would say the possibility or the probability of that clearing up. So long as it is an essential business and there's continuous business transaction happening, right, and there's margin, there's a positive margin, then they will have profits and they will be able to clear it. I mean, like for example, you wouldn't worry whether, say for example, you have Sheng Siong, let's say local context, Sheng Siong or NTUC, let's say they have high level of debts. Will you be worried whether they will be able to pay it off? No, because they are something that you need to buy from them day to day for your essentials. The same thing for CVS, because for example, if let's say you need to see a doctor, you need to see a doctor, and for US it's not so simple when you need to see a doctor and you need to buy medicine, you need to do a whole spectrum of seeing doctor, getting a medicine. So I'm not concerned whether they can pay off their debt.
Yes, that's specifically right, Jeremy. I just wanted to say that because, like Ryan, like we said earlier, right? There is a reason why investors are not liking it right now, right? And you just brought up the exact reason, right? You must understand. There's always reasons why the stocks are this cheap. Yeah, okay. Because if there isn't any concerns, right? If there isn't any concerns, then the stock price will be flying sky high right now. Okay, but they are obviously not. Okay, so in terms of why, then this has to be the reason. Every investor out there in the market has the same concern as you do, right? They're worried about the debt load. Okay, so if you want to spot these value opportunities, then we need to try to look at things beyond. Yeah, okay, beyond. So, like Jeremy pointed out over here, the essentialism of the business design itself, right? You realize the entire parts and puzzle of the process, right, generates cash flow. It's a cash flowing business. Yeah, okay, all right. So as long as they produce cash flow, that means there's always going to be excess to keep paying down the debt load. And to be honest, right, the way I look at it is this: they don't even need to clear the debt. They just need to bring the debt down to a acceptable level. And you'll start to see the stock price flying. Because with the high profitability that they generate, with the lowered down debt load, and showing investors that they have the willingness and capability to bring down the debt load, that's going to turn the opinions around immediately. And we all know when great companies are able to turn the opinions around immediately, right? What happens to their stocks right away? It flies. All right? You would have seen this happen to Procter and Gamble a few years ago. Yeah, all right. It suffered the same process where it was down, right? It's a little bit shorter, I think about 1 year. right? And the moment the company turns around and shows the profitability over here, right, it immediately shot back up to the previous highs, I think in under 6 months, right? And of course, right now it actually broke the new highs. Yeah, okay, so this is the potential that we're looking at over here, I would say. Yeah, okay, Ryan, I hope we answered your question over there. Vincent says the story of the company really lets me see that CVS is like Apple, right? That's about to launch iPhone and dominate the healthcare industry. What do you think, Jeremy?
I think we might actually be seeing the start of a healthcare empire starting in US. Yeah.
Yes,
if you ask me.
Correct. That's why I actually labeled today's play as value and growth. Because it is actually a value play, and most of us most of us in the community, if you have been with me for a while, right, you would be familiar with this company, right? Yes, there are things that we don't like about the company. Yes, we hate the stock price for the last couple of years, but like, I hope you're like me. We just start to realize that it's misunderstood. Because do you realize, Jeremy, you said that one thing that you didn't like was the fact that they haven't raised their dividends for a couple of years?
Yep.
But do you realize that there is actually a legitimate reason why they did so then?
Because there's so much debt now.
No, not so much that. Because do you realize, if you look beyond, that's one thing. That's one thing. But that's because they're prudent. Right? Now, why do I say that? Because they know that they have a debt load coming up, right? But at the same time, do you realize they didn't cut the dividend?
Yes, they didn't.
Yeah, they just held it there. Right? And by holding it there, what they're telling investors is stick with us, please. Stick with us, because once we write this issue out, we should be able to resume what we promise you. Right? Because this brought me back to looking back at Intel, because Intel did something like that. Right? Because when all these smartphones and gadgets were coming out, right, the technology that was in play was ARM. Right? I don't even know if they're still the play right now. ARM, which process all these chips for these smaller gadgets over here, and Intel was losing the race. So what Intel did was they decided to also hold their dividend, right, and use the savings over here to put more into R&D. Right? And then when the profitability starts to resume, their positioning resumed over here, they started going back to what they promised investors. So CVS is doing something like that. So the thing is, yes, while they did not continue to raise their dividends per se, right? But one thing is, as I said to many of you before as well, when a company decides to do so, then you need to find out what's the story behind it. Of course, if you're not willing to find out the story, then don't touch it anymore. But this happens to be the reason why we're bringing up the stock today, because we found the reason. So we want to bring it to your attention and let you decide if you buy the idea or not. Because going back to what Ryan said earlier, Ryan, think about this as well. If the management is capable of bringing such elaborate plans and long-term plans to build this empire, to build this empire, if they were concerned about their debt loads and they were concerned that they can't manage the debt loads or their cash flow viability, right? Don't you think they would actually eliminate all the dividends entirely? Because $2 a share is not a low amount. $2 a share for a year, in terms of how much shares they have out there, that's millions out there, right? They could have saved, right? And they could have in fact used it to pay down debt as well if they are really concerned, right? I think this shows that the management knows what they're doing, and they know that they are capable of handling the numbers, right? I mean, that's just my take, of course. All right, remember, all right, I can't put a disclaimer on the screen, okay? But the PowerPoint was up there, okay? All right. Yeah, all right, now, so that's Vincent over here.
Terence, can I?
Sure, jump in, please.
Can I quickly address Sarah's question on the price forward earnings?
Yeah, sure.
Okay, Sarah, your question is actually on the current price forward earnings of 8.83. Is it promising? I just want to caution you here. Even though there are certain benchmarks for certain parameters in terms of fundamental analysis, in terms of reading the ratios, right? Generally, it's better for you to do a comparison either against an industry benchmark or a company's historical level. So, for example, if you're looking at 8.83 current price forward readings, right? Let me share my screen here. right? Okay, so what you're seeing here is from Morningstar CPS, the price forward earnings of 8.3 currently, right? The those called direct comparison is you're just going to compare against the 5-year average of 11.92. So on this basis, right, the straightforward understanding is that it's cheaper now in terms of the 5-year average for the price by basis of the price forward earnings. Now, the thing is using forward earnings, right, there's this concern whereby is it the case whereby the forward earnings is going up, or is it the case that the price is going down? This one we don't know. So just looking at this alone, right, you can't really tell. So just using the price forward earnings on its own, you can do that, but I wouldn't recommend if you just do that on its own. Try and use a whole spectrum of the different parameters like I did in my slides when you are trying to do form out your own opinion of the stock. Yeah.
Okay. All right, great. Now, so let me just move on. Done, right, Jeremy?
Yeah.
Okay, great. Okay, now, so Glenda brought up a point. CVS is a long-term play, and CVS is smart to integrate insurance as medical. All right, it's one of the high inflation items. Right now, yes, this is basically what we're building our story and our opinion on, especially for me. Right, I'm not sure Jeremy has the same view after my sharing so far, but yes, this is definitely what we're looking at over here. Because I'm just thinking it this way, Jeremy. I'm not sure if you agree with me, or community members. I'm not sure you agree with me as well. Pretty much, CVS looks like a company that has undergone restructuring, right? Because of the bad outlook of the company. So this brings me back very much to the Procter and Gamble play. All right, the Procter and Gamble play. Now, why do I say the Procter and Gamble play? While I speak with all of you over here, just give me some time if I look like I'm preoccupied, because I'm just trying to bring out the chart so I can elaborate further to all of you. Okay. All right, Jeremy. You don't have an appointment with anyone important, right?
No.
Jeremy's gonna kill me. All right, Jeremy's gonna kill me, guys. All right, Jeremy's gonna kill me after the session. I'm sorry, Jeremy.
It's okay for the community. I'm fine.
I promise not to do this again. Or I promise to try not to do this again. Okay, give me a minute.
Yeah. Let's see.
Okay, you can take a look. You can pick up any other questions and then address it before I.
Yeah, I think Uncle Fu raised out a good point, which is the free cash flow has been increasing and profits have increased. So this is a good sign that the company is actually on a better state in terms of its balance sheet here. That way, yeah, I think Uncle Fu, you have a good spot here. This is also one of the things that we will looking out for in terms of the state of the company. If I could recall, the free cash flow actually measures the flexibility, the amount of a leeway that the company has. So this is a good measure in terms of like CVS compared in the past compared to now, right? They actually have more leeway in terms of what they need to do. Yeah.
Okay, having just read Uncle Fu's comment, I already know what he's gonna do already. Uncle Fu, I know what you're gonna do already. Right, glad we are able to bring a stock to your attention over here, Uncle Fu. All right, great. All right, now so basically at least sessions like this is going to end up bringing profitability to your pockets, right? Actually, it'll be great. It'll be great if any of you who actually pick out some of the stocks that we discuss during sessions like this. All right, if you have done some trades on them and generated profits on them, all right, perhaps send me a message over here, right? Send me a message and let us know how much you are able to make out of these profits. Yeah, all right. How much profits you are able to make out of these suggestions over here? I think it'll be a good thing over here, right? Because it will help us, to let others know, right, that joining and listening to a session like that on the weekends, all right, can actually produce more money for them. Yeah. Okay. All right. Now I'm ready. Let me get to my share screen over here. Okay, all right, now, so what I'm trying to say over here is if you look at my screen, right, and sometime in 2018, right, so this is the restructuring period that P&G went through, right? It went from 85, it went down from 85 all the way down to about 65, right? So that's like a $20 drop, right, for P&G, which is like, a total blue chip for the longest time ever, all right, that we know about. Yeah, okay, so they went through a restructuring period where they had many of their brand names that were not performing. So they went through a cycle where they, started selling off all these brands to other companies that want them, all right, and ditching off all the non-performing assets, and they kept all the money churning ones. So when they're finally done with that and their balance sheet looks better, right? So you realize it went down over a period of about 6 months, right? Okay, all the way down, and then in the next 6 months, right, it actually almost recovered. All right, it almost recovered to the previous high. All right, and you can see it went down again, profit take. All right, and then there was a gap up. All right, I can almost certainly tell you that this gap up is probably caused by an earnings announcement. Okay, all right, I'm pretty sure that's the cause of it. All right, so the earnings was announced, and then it significantly erased everybody's objections and everybody's fear. Right, and you look what happened since then. Right, it went on to new highs over here, and it never looked back. So I'm just assuming that we can actually potentially see CVS do such a thing. All right, that's why I want to spend some time bringing up these slides over here. Yeah, okay, all right. Now, so I just feel that this is something you could really look at over here. All right, great, Christine. Thank you very much. All right, thank you for letting us know you generated some cash flows during this period. Okay, all right, great. Thank you for letting us know. Okay. Okay, now I think we are pretty much detailed over here in terms of covering the stock. Let's get to the opportunities over here. Okay, so sorry, Jeremy?
I think the community is looking out for the low budget way of trading the company.
Yes. I just want to save that for the last. So basically, all right, how to play it. All right. So the first thing is, of course, if you buy the stock so much and you buy the idea so much, long it, long the stock itself. Okay, long the stock. Next, you could buy a leap in the money call. So all these are going to be different strategies that I've discussed over the course of Project Options Cash Flow. Okay, all right. Now, so if you've not done so, just go over to our website and list yourself and join the list for Project Options Cash Flow, so you can see what are the strategies being taught over there. Now, think of Project Options Cash Flow as a mini options course over here. All right, and you're going to get it for free. It's entirely free. Okay. Now, so one, long the CVS stock. Ryan. Ryan. Okay. Now, next, buy a leap in the money call. All right, so leap in the money call. So if you can afford it, all right, you could be looking at something like that. So CVS right now is about 62, 65. All right, so if you buy about an 80 delta call option, it will cost you about 1170 to 1180. All right, 1170 to 1180. So about a $1,100 investment, all right, on 100 shares. Okay, think of it. It's already a much discount. Right? Why is it a much discount? If you go and buy the share itself, right, 100 shares is going to cost you $6,200 to invest in. All right, but by buying a 80 delta call, right, that expires only in January, another half a year from now, right, it's only going to cost you 1,170 to 1,180. Okay, so that's the next one over here. Buy a simple call over here. All right. Now, next one over here is, of course, like what Jeremy mentioned. You could sell portfolio naked puts. All right, so some suggestions have been brought up by Jeremy as well. And lastly, ready? Ready? All right, the free lottery trade. All right, free lottery trade. How will we design this? Okay, now, just specific to this opportunity, I will redesign the free lottery play a little bit. Okay? I can't help but do this, Jeremy. All right.
Right.
I need to test how many people are still alive over here. All right. Now, how many of you want to know this design that I've just put up for this stock over here? All right. That means you limit the risk, but you keep the upside potential. Okay. You limit the risk, but you keep the upside potential. Okay. Maximum upside potential. Okay. How many of you want to know how this can be played over here? All right. If you do, all right, type. What should we make them type, Jeremy?
Free lottery trade.
Or just type free. Just type free. Free will do. All right,
free.
Okay, leave a comment. Free. All right, leave a comment. Free. All right, and I'll do it. All right, it's coming in. It's coming in. It's coming in. All right. Okay. Okay. So y'all don't want the story. Y'all just want the money. All right, guys. All right. When I say guys, I mean ladies and gentlemen. Okay. All right. Now, yes, making the money part is important. It's of course the most exciting part. But please understand, you need to understand every investment that you're putting your money in as well. Right. So that's why we spend the effort and time trying to address it before we come to the final part. Now, so the way to do this is this. Think of it, the free lottery play should be something like that. That means I may be thinking about perhaps selling aggressively, okay? All right, perhaps I'll be selling the 6250 put option. Okay, all right. I'm clicking on the wrong screen. Give me a minute. I'll be selling the 6250 put option. Okay, all right. Now, then I would actually turn around. Okay, give me a minute. Okay, I'll actually turn around and buy perhaps the 65 call option. Okay, all right. Now, as you can see, by doing this, right, immediately, all right, I'm actually going to pocket 177 in credit. I mean, somebody's going to pay me 177, right, to take on this entire trade. So what's the risk of this trade? The risk is, of course, the downside. Okay, if the stock goes down, that means if it goes below 6250, right, I would have paper losses, or all right, if I want to realize it, then eventually they may end up as realized losses. So the further the stock price goes down below 6250, the bigger my losses become, right? Because essentially, right, I'm promising to buy the stock at 6250. So anything below that means I will lose money, right? Okay, now, so if I realize those losses, that would be the loss I'm looking at. So, some of you were asking, Terence, is there a way I can play this with the safety? I think even Jeremy was looking at it just now. Right? You want a pure play on it. That means you believe the upside, but you are also worried. Okay, so I think Ryan will probably look at this as well. Okay, now, so if I'm that worried, right? If I'm that worried, then the thing is this: I would actually want to buy the call option, but by buying the call option over here, it would have been costly. Okay, so it would have cost me like 1,100 to bet on it, to bet on a story like that. Okay. But, looking at this structure, it gives me the potential. That means if CVS were to go back up all the way to 95, okay, now it would mean that my 65 call option will be worth $30 by the end of this. Okay, it'll be worth $30. That means potentially I may be looking at a $30 potential profit out of this trade. Okay, so if I'm expecting a potential profit of $30 on this trade, right, I will tell myself this: I don't mind spending some money on it. Okay, what do I mean when I say I don't mind spending some money on it? That means, right, instead of selling a naked put over here, right, what I can do right now is I can turn around, all right, okay, and limit the risk on the put side. Okay, what do I mean by limit the risk on the put side? That means instead of selling a naked put over here, all right, I can go out there, right, and perhaps control the losses by actually selling a put spread instead. Okay, all right, now, so I would actually sell a put spread, for example, a 62.50, 57.50 over here. All right, now, and this would in turn then turn the entire trade into a $2 debit trade. Okay, that means I will actually have to pay $2 to get this entire combo in place. Okay, but this $2 over here will come with a limited loss of $5. That means if the stock collapses, it goes down. All right, and we are totally wrong. My limit on the loss will be $5 plus the $2 that I'm paying up front. So about $7 over here. Okay, all right, now, so you can think of this as a play where you put $2 up front over here, all right, and then you can get the trade in place. Okay, or if you're comfortable, actually I'm more comfortable over here with the previous design, which is just this outright. All right, getting someone to pay me 177 up front, all right, to do the jackpot trade itself. Okay, so this is something you could look at as well. Yeah, okay, all right, now, so Yep, this is how I look at it. So there are two ways I'll play this over here. One is definitely just to buy the deep in the money call, all right, and then two will be to structure this jackpot trade that I'm putting up in front of you. Okay, now, why is this put out as a negative? All right, so Kenny is asking, Why is this put up as a negative 177 credit? Now, can you see that's because this entire combo is structured as a buy order, right? You can see the order form is in green, right? So it's a buy order. So you're buying at a 177 negative, which means somebody has to pay you 177 to buy this combo. So essentially meaning the same thing, right? If this was red, that means if this order was entirely red, then you would not see the negative sign. It's just the way the broker presents it, Kenny. Yeah, all right. That's a simple way of looking at it. All right, everyone. All right, now, so these are the different ways you can play at it over here. All right, one, if you want to limit, actually, I think this will work better, right? That means I honestly don't foresee this happening, all right? But let's say you don't want to lose more than the bottom that CTS did, okay? Which is during COVID, it fell to about $52. Okay, $52. Then I think this is what I'll structure over here: $62.50, and then I will sell the $52.50. Buy the $52.50. Yeah. Yes, this makes more sense. All right, now, so this will be something you can look at over here. All right, now, so this entire combo with an unlimited upside will only cost you 57 cents, all right, upfront, and you get a half a year bet on the upside. Okay, you get a half a year bet on the upside on CVS over here for just 58 cents upfront. Okay, based on Friday's closing price. Okay, all right, now, so this is something you could decide on your own, all right, and Monday comes, if you really like the stock over here, have a look at it and decide how you want to play it. Yeah, okay. For the combo I presented over here, if you are trading it for the jackpot trade itself, you could look at 20% deposit for the naked puts. Okay, all right. For this last one that I mentioned over here, the deposit requirement will be 1,000. All right, 1,000. Right, because the put spread that we set up has a potential $10 max loss. Right, so that will be a $1,000 deposit on one option trade. Okay, so you are putting up $1,000 deposit for a potential $3,000 profit if it goes up to 95. Okay, all right, Jeremy, any last words to add on over here?
Paris, I just have a question here. Will you actually consider taking this trade after the earnings season?
You want to answer that first?
Myself.
Yeah, I want to see what you say first.
For me, I tend to err on the side of caution. So for me, an opportunity missed is better than a mistake made. So I will consider taking it maybe if earliest will be in the middle of the earnings season. Or if not, I will take it after the earnings season itself. At least for the current one.
Okay, I don't disagree with you. That means those of you who are similar to Jeremy, that means you are afraid that the earnings may surprise everyone. Then by all means enter the trade after. All right, but just to a certain extent, right? If you look at the numbers that we were sharing just now, right? Just in the last quarter alone, right? The increase in visits, sales, and everything like that, right? Won't you expect CVS to actually start dishing out better than expected numbers? So if you believe in that is going to happen, right, then it might make sense to get in at this moment. Or I think a prudent player will be do a half-half or one-third. That means, if, for example, if you actually have the intention to do 3 contracts, then go in one right now, go in one after the earnings, and then one whichever when you're comfortable. But of course, if you are only looking at one, then you have to make a decision. Yeah, all right. So that's always how it is. But if you are sizing in, that means you're doing more than one contract, you are in control. You can always go in 50-50 first.
Fair.
Yeah, all right. Yes. So it really depends on your risk appetite and what do you assume the company is going to portray in the next upcoming earnings. Because if they are, running 14,000 test centers right now at their outlets, and they are seeing more patients right now in their clinics, all right, as well as the digital, and they're sending out 1,000% more medicine through delivery during this period, So I don't know. I just assume that the numbers are going to look much better, right? Because the debt problem is already existing. But if they can prove that their profitability has shot up during this quarter compared to 1 quarter ago, right, then it may start to inject some positivity out of the company. All right, and we all know, earnings, when they inject positivity, what kind of jump, is expected to be seen when it comes to the share price.
Fair.
Yeah. Yes. So that's basically what we're looking at over here. Now, so just a final question over here. Basically, based on our trade, the real profitability kicks in when the stock goes above the call strike, which is 65. Okay, now, but what if it lands between like 62, 50, and 65? Then, you're just going to realize this loss of 57 cents debit then. Because you paid 57 cents to start, and in the middle of 62 and 65, right, none of the put options and the call options have, gone in the money. So basically, everything is just going to expire. Yeah, okay, now this combo has unlimited upside gains, but limited downside risk. Yeah, okay, all right, it's unlimited upside, but limited downside. Okay? All right, I think we have done enough today, Jeremy.
Sure.
Overdone it. Yeah, or, one of my kids' favorite games right now is Overcooked. I think we have overcooked this. Oh my goodness.
Yeah, but I mean, I really enjoyed the discussion today because it's very engaging and we were in the flow. Yeah, kind of.
Yeah, I think it's really good session as well. I hope those who are still with us right now really enjoyed this. All right. If you really enjoyed this session over here, all right, just show your appreciation to Jeremy. All right. Okay. Help us to share the video out. All right, because now you know the whole story. If you have not done so, just click on the share button. All right, so more people will be able to see the or understand itself. Right, but do us a favor, just add in a headline when you share it out. All right, so people know it's just not any video, but a great stock discussion, a great opportunity that they could look at over here. All right, a great stock opportunity. Then people may be interested to actually see what's the content over there. All right, now, so if you found it useful, just drop us a comment over here. Let us know. All right, thank you very much for joining us in episode 3. All right, we'll look forward to seeing all of you in episode 4 over here. All right, for those of you who are joining us in Singapore right now, the new dawn has happened. It's a new beginning. All right, so we all hope, for the country as a whole, all right, we'll move towards the right direction, of course. Okay, right now. So thank you everyone for joining us, and we continue to seek your support. And of course, we hope you appreciate the sessions as well. Bye-bye, everyone. Have a good weekend.
Bye-bye.
Jeremy, bye-bye.